And September is off to a rocky start with plenty of catalysts on deck for the rest of the year, including economic indicators to indicate whether the economy is tipping over. And of course, we had the U.S. presidential election in November. With all these potentially market-moving events coming up ahead, how should investors position their equity portfolios? Well, let's invite Dan Ha, co-founder and portfolio manager of Karani Asset Management, for his thoughts. Dan, so great to have you here today. Thank you so much for joining me.
Thank you for having me.
Well, it is a holiday shortened week here in the U.S. We had Labor Day as a holiday on Monday, but the sessions so far this month have started out quite volatile, and there is something called a September effect. So as we head into the rest of this month, as well as quarter end, where do you stand right now?
Sure. So first of all, I'm a fundamentally driven long-term investor. So, thinking about 1 month, it's a very short period of time, even a quarter, quite frankly. So knowing whether to take risk on and off on a monthly, quarterly basis, it's just a very difficult thing to do. Now, going back to the 1920s, it is true that September has been the worst month of the year, going back 100 years. It's on average been a negative month. However, just knowing that fact doesn't really help an investor figure out whether this September in particular is going to be an up month or a down month. So let's actually look at a few slides. If we pull up slide number 1, please. So again, back to the 1920s, the statistic is that 45% of the time September has been a down month. Which means that actually more than 50% of the time, September was actually an up month. And if you look at the more recent 50 years, the win-loss ratio for the month of September has actually been 50-50. So despite all the worries and fears around how bad September could be, September, just historically speaking, actually hasn't been that bad. And if we go to slide number 2, please. So the table on the top, this is perhaps why the market gets so nervous about September. All Septembers since 2020 have been negative, all 4 consecutive years. And in 3 of those 4 years, September was actually the worst month of the year. So, and for most people, recent events tend to get overweighted in their memories. So it's understandable why the market might get nervous about September, because they remember what September did recently. But it's also important to remember the lower chart, which shows that whatever ended up happening in September, almost 80% of the time, the market actually rose in the following 12-month period, and it rose quite handsomely at a median of 17%. So September can really go either way, which is same for, frankly, October or November or December or any other month. And so, it's the point in telling all of this is that investors really shouldn't be thinking about their portfolios in terms of what might happen just in any 1 month, whether that's September or any other month of the year.
And I think, Dan, it's very helpful to get this perspective and take a bird's eye view and look at historical trends when it comes to the month of September. Because if you're just looking at headlines out there, you hear about the September effect and the way that we started off this week, especially with all that volatility. There are concerns out there, but that is just a day-to-day thing that we're talking about in terms of today.
Right.
But I think there's a lot of nervousness out there, a lot of jitters, especially after what we saw on August 5th.
Right.
So as we head into this month, I think it's so important to keep in mind. And of course, I know that you focus on the long term versus a day-to-day or even short term. So when it comes to the longer term outlook for U.S. equities over the next 12 to 18 months, are you bullish or are you bearish?
So one thing I'll say is you'll never hear me say that I'm simply bullish, whether I'm simply bullish or simply bearish. When it comes to the markets or even individual stocks, I don't think about it in such a binary fashion. When it comes to investing, I'm always thinking about both the risk and reward. Meaning, if the market went up, how much could I make? And if the market went down, how much could I potentially lose? And the range of potential outcomes is, if it's about even, then frankly, I'm not so interested. My job is to look for opportunities in the market where the risk reward is skewed in my favor, and avoid those that are skewed against me. If you actually pull up slide number 3, this is a graphical view of what I'm trying to say. The kinds of investments that I prefer to pursue are the one in the middle. Heads I win a lot, tails I lose a little. This is what I mean by a favorable risk reward that is skewed to the upside.
And it's very interesting, Dan, because if you think about Wall Street here in New York City in the financial district, we have a statue of a bull, but not of a bear. And there's so many theories as to this exact origin story, how this came to be, these two animals representing the highs as well as the lows. But when it comes to this risk-reward framework that you just mentioned and we saw in the charts, when it's applied to the equity markets, how are you applying it right now?
Sure. So first, let's think about the upside, the bullish scenario, the potential reward in the risk-reward equation. If we could pull up slide number 4, please. So let's suppose we're in a bull market. We don't know, but let's just suppose. If so, then 2024 would be year 2 of a bull market. Last year was an up year. 2022 obviously was not. Bull markets back to around 1950, the post-World War II period, typically lasted approximately 1,800 days, or about 5 years, and delivered better than 100% return cumulative on a median basis. So if the July high of the S&P 500 of 5667 was the peak, meaning that we're actually right now sitting in a bear market, then the 2-year bull market that we experienced since October of 22 to up until this summer would be among the shortest bull markets in modern history. Now, there have been short bull runs in the past, so by no means am I saying that this could not have been one of those short bull runs. But what I am saying is that if we are in a bull market, history suggests that we probably have some more room to go, which would be great. Now, some might be saying, how could you be bullish when we've got all these problems in this world, and list all the reasons why it's impossible that we're in a bull market. The truth is that, as the saying goes, bull markets do tend to climb a wall of worry. Meaning, bull markets typically begin with fear, and that leads to which we had in 2022. Then to skepticism, and then less skepticism, then some optimism, then a lot of optimism, then finally euphoria. So it's not inconceivable that we're actually in a bull market, as difficult as it may be to believe, because the fact pattern simply is that we had a bear market in 2022, and we could now be in a new bull market. But how that happens is only going to be obvious in hindsight.
And I do think hindsight is always 20/20, and without a crystal ball, it's hard to tell what's going to unfold in the coming months.
And if we could actually load up slide number 5. This is one thing that I will add to the comment that I made. If this is indeed year 2 of a bull market, then there is a good chance that the returns over the next 12, 24, 36 months may not be as exciting as what we saw last year or so far this year. Historically, it's the early years in a bull market where the returns have been the strongest. Now, the past is obviously not necessarily indicative of future results, but that is the historical data.
And I think that's very helpful to get that perspective, especially in a year like 2024 when we continue to see record highs being hit for the major equity averages, but so much volatility as well.
Right.
But overall, Dan, would you say that you're more optimistic than not?
Well, I haven't told you the bear case yet. So again, just to summarize, the bull case summary is that if we're in one, we probably have some more room to go. And even though it may not be as exciting as what we saw last year or so far this year, or even though it may be somewhat choppy as we sort of chug along, up is up. So you want to stay invested to participate in the bull market, and as the saying goes, you don't want to lose your place in a bull market. That's the bullish scenario.
Okay.
Not necessarily a prediction, but a scenario. Now let's talk about the bearish scenario. If we can pull up slide number 6, please. So here's the reason why I think any indication of a slowdown of the economy is taken so sensitively and so negatively by the market at this juncture. What this graph shows is that bottoms in markets typically happen during a recession, not before or not after the recession, but during a recession. Now, that's certainly not always the case. In markets, there's really no such thing as always. But this is more often than not. Markets tend to bottom before the actual economy does. If we can pull up slide number 7, please. So of the 8 bear markets going back to about 1950, that coincided with the recession. And it's important to also note that bear markets don't always happen with the recession, but of the ones that coincided with the recession, out of 8 of them, 7 of them, the market bottomed before the economy bottomed. In other words, while the economy was still in a recession is when the markets have bottomed. So if you take a step back and think about what that means, there are plenty of very smart people out there who think that a soft landing is a fantasy, and that somehow the Fed this time somehow magically lands the economy very safely, very softly, after fighting the kind of inflation that this country hasn't seen in 50 years. That's just simply unrealistic, is the bearish argument. And if the premise, therefore, is that the recession is on the horizon, say over the next 12 to 18 months, the really scary thing from the market's perspective is that like I said, markets typically bottom during a recession, not before. So our recession hasn't even come. Whenever that may be, the market bottom is still some ways out, which means that we probably have a pretty long a downside to go if we do get a bear market.
And Dan, I think that's so important that you mentioned that distinction where we're talking about recession and bearish case scenarios, because if you see some of the headlines out there, there are a lot of other indicators that might grace the financial media headlines, whether we're talking about the SAM rule or any other indicators. But what is your advice to viewers out there, retail investors out there who see so many contradicting headlines, and for the long-term investor out there, what should they be paying attention to?
Sure. So like I said, you always have to think about both the upside scenario and the downside scenario and weigh the outcomes. I mean, the future is the future. Some people believe that you can predict it, but it's very difficult to predict. Taiwan the other day said that the future is very difficult, or the predictions are very difficult, especially ones about the future, right? So therefore, it's important to think about both the upside and the downside. What is really worrisome in terms of positioning and in terms of going all in on the bullish positioning, with the idea that this could be just year 2 of a bull market, is like I said, that there is still this risk that the economy will tip over into a recession. And the scary part is that this particular recession has the potential to be a pretty bad one. It's impossible to know how bad a recession is going to be or how bad a bear market is going to be. But here are some facts that make this next recession, whenever that may come, particularly worrisome. If you think about it, this country hasn't really has had a real recession in 15, 16 years. A behavior changing recession, that is. And that is a very important point. You might be saying, well, but we had a recession in 2020, the COVID recession of 2020, which lasted 2 months, which was technically a recession. But recently, I actually had a chance to have a discussion with Howard Marks of Oak Tree Capital, who's making headlines today, about this. And the idea and what we were talking about was, should we consider the 2020 COVID recession to have been a real recession or simply a technical one? And the insight that Howard Marks had was, the question is, did it change behaviors? And that's the key question. And what we mean is, we don't mean changes in behaviors in terms of, okay, people are now coming into the office less, working from home more, or we're now washing our hands more often, or are more conscious about germs. That kind of behavior, that's not what we're talking about. We're talking about behaviors around risk appetite, behaviors around how people feel about their future, how secure their future is, and the prosperity of that future, the job security, people's behavior around spending and splurging, the availability of capital in the system. So when we think about it from that standpoint, did the recession of 2020 really change behaviors? 4 years later, sitting in 2024, personally, I don't think so. So if we then say that this economy really hasn't had a behavior-changing recession in over 15, 16 years, or in about 15, 16 years, and add on top of that, we're in a situation where we have record government debts, and we're unwinding years of extremely accommodative monetary policies, zero interest rates, negative interest rates, expansion of Fed balance sheets, and now the shrinking of the Fed balance sheet. All of these elements adding up suggest that it is not inconceivable that the next recession, whenever that may be, could be a pretty bad one. And if the next recession is going to be a pretty bad one, it's kind of hard to see how somehow the equity markets are just gonna have a mild bear market in response to the recession that might actually cause it.
And Dan, your focus there when you mentioned recession and what we saw in 2020 with the COVID-19 pandemic, that is a once-in-a-generation event. And perhaps a black swan event as well. But when we're talking about a real recession, as you mentioned, and what the implications will be for investors out there, from an economic perspective, what are we talking about? Do you have a threshold when it comes to data points, key data points such as GDP or inflation? What does that encompass when you say a real recession?
Sure. So kind of going back to the definition of a real recession, we come back to, we ask the question, did it change behaviors? So some of the things that internally that we have looked at to gauge that were signs of, for instance, speculative behavior. So back in 2022, we were looking at data points to see, for instance, how is the IPO market doing? How's the M&A market doing? What are the performances of some of the more speculative pockets in the overall equity markets? We obviously had the meme stock craze, and that crashed spectacularly. A lot of the unprofitable companies that were flying high in 2000 up to 2021 crashed spectacularly, and a lot of them didn't come back. The tech sector, which also had a lot of had some froth and sort of bubbly aspects to it, that sector was hit harder, and not all of that activity obviously came back. The cryptocurrency market, I'm not going to sit here and say all of cryptocurrency is just speculation. There are some very good arguments as to there are some cryptocurrencies that are very potentially legitimate, but there were also all kinds of cryptocurrencies that just because it was crypto, it went up a lot, and that crashed spectacularly. So we would be watching those things. The somewhat worrisome aspect of watching those indicators, though, is that a lot of them have started to come back. And the behaviors, again, the behaviors of and the availability of capital does not seem to have necessarily changed enough post the 2020 COVID recession. So it was a pretty short-lived recession. It was a pretty short-lived, sharp but short-lived bear market, and the behavior changes that come with it also seem to have been fairly short-lived, which is why we are somewhat worrisome when it comes to the risk of the next recession and what that might mean for the equity markets.
And Dan, when you talked about the meme stock craze, we look back to previous recessions and the advent of certain types of technology, certain types of access in terms of retail investing did not exist. So for investors out there, given the scenario that you laid out, how can they be defensive? What does that imply?
Sure. So, I'll turn that question into more of an overall positioning question, and put positioning comment, I should say. So I don't think at this juncture, despite all these sort of potentially scary things that I said, I don't think investors right now at this juncture should be all defensive or all offensive. Like I said, the risk of our actually being in year 2 going on to year 3 of a bull market, therefore the upside risk, if you're too defensively positioned, is too high. So the recommendation, the first recommendation, or the first suggestion is that you should be invested. The historical data is on your side when it comes to being fully invested if you're a long-term investor. So you do want to stay invested. That way, if we are in a bull market, you may not catch the highest rates of returns available in the market, but your upside will be plenty if you remain invested in a bull market. Now, if we are in a but what you want to own in the equity markets are companies that are likely to be defensive if the bottom falls out of the market. And what I mean by defensive aren't necessarily simply defensive businesses. Being defensive, owning defensive stocks is both a combination of the business model as well as the valuation. So you could own a very defensive business, but if it's priced like a growth stock, that holding on to that is not going to do you much good if we get a bear market. So you want to pay attention to the quality of the business. And for us here at Karani, we really like to see businesses that have staple-like characteristics, or businesses that are very difficult to replace. And you want to buy those, and you probably don't want to pay record multiples for those companies. And so those are some of the things that I would think about as investors think about their portfolio positionings today. Again, not to play completely offense, not to play completely defense. Right now, at this juncture, is I think time to maintain a pretty balanced position.
And Dan, before we move on, I do want to take a quick market check as we head into the noon hour. We are seeing the major U.S. stock averages in negative territory on this Thursday, on the eve of that all-important jobs report coming out on Friday morning at 8:30 a.m. So we are seeing the Dow Industrials down by 0.8% or down over 350 points, so extending some of that weakness we saw earlier this morning. Meanwhile, the NASDAQ Composite Index is also in negative territory right now, but has paired earlier losses, but it's still lower by 0.1%. And the S&P 500 is also in negative territory, down by about 0.5%. So, of course, Dan, we'll keep an eye on the markets, but I do want to shift our focus back onto the topic of the day. So can you tell us a little bit about some of the areas that you would like to avoid when it comes to the long term?
Sure. I'll talk about both the areas where we find attractiveness, and also areas where we're avoiding right now. So from a sector perspective, right now we actually do quite like the large cap technology space. And to be clear, that's not the entire sector. Obviously you have to pick the good companies within the sector. But we do see some decent opportunities in the large cap technology space. And the reason being is that many of these large cap technology companies are really selling you essential tools and services for lots of businesses and consumers today. Software, for instance, is something that essentially all businesses in this day and age and a lot of individuals really depend on. And once you get used to using these softwares, it becomes very difficult to just rip and replace. So yes, in a recession, everything slows down, and software clearly by no means is going to be completely immune from that. But if you can sort of narrow your focus on companies that are selling these essential tools that are necessary to run the day-to-day of lots of businesses and even us individuals, those businesses are likely to do better and slow down less or even go down less than your average company. And of course, if you're not paying a hefty multiple to buy those positions, it is, on the downside, if the market were to go down, it is our view that those will probably be defensive or the stocks will behave defensively as the market seeks, or others in the market seek flight to quality during times of trouble. So that's the downside scenario. On the upside scenario for some of these large cap technology stocks, a lot of these companies could still be and very much will be a beneficiary of the secular growth trend, secular growth of more and more use of technology, which is still very much the case, or alive and well. And also, especially if you're exposed to, for instance, AI, which a lot of people think if AI is as attractive an opportunity as a lot of people think, a lot of these companies will benefit from that as well. So I don't see why these stocks will necessarily underperform even in an up market, especially over the long term. We'll probably be able to at least market perform, if not do better. So from a downside standpoint, we think these companies could potentially be defensive in the downside, and be just as attractive as the market, if not better, on the upside. But obviously, you do have to be selective. And just to finish that thought, in terms of areas to avoid, going back to the idea about having skews that are in your favor. Any outcome that are really binary in nature is like a coin toss. So right now, there are a lot of very smart people who think small caps present a good opportunity. I don't necessarily disagree with their analysis, but to me, small cap seems to be an area where if we have a bull market, it'll probably do really, really well. But if we get a bear market, it'll probably get crushed. And so that kind of binary outcome is just something that, personally and as a firm, we're not interested in. And perhaps just to give you another example, more sort of an election-based bets, betting on the outcome of the election. So whether that's the Trump basket, companies in the energy, industrials, defense, financial sector, etc., that will likely do well if Donald Trump becomes president, and will lighten up regulation and be friendlier to these industries, or the Harris basket, if that is, I don't know if that is a thing yet, but I guess that's just the opposite of the Trump basket. If making those bets on the outcome of the election is really binary in nature, therefore it's the kind of thing that if you want to make a bet on that, I would probably keep the exposure pretty small, pretty contained.
And of course, we'll be keeping an eye on comments that are coming out from both the presidential candidates, especially as we head closer to that debate next Tuesday evening.
Sure.
But one thing that you mentioned that I do want to close out with today is that you mentioned small caps. And there was this narrative earlier this summer when we were seeing a rotation out of some of those Mag 7 names. And this was before the August 5th sell-off that we saw. But can you walk us through why you said what you did when it comes to small caps and what we really need to keep our eyes on when we're talking about rotation, the details of what small caps really entail?
Sure. I mean, just to clear that up, if somebody has a very strong view about where the market is headed, and therefore they think they're really sure that we're in a bull market, and this bull market is going to go on for a few more years, by all means, investing in small caps is probably the way to go, because a lot of these stocks have, over the last couple of years, underperformed the broader equity markets, or especially the larger cap peers. Which means that if we're in a bull market, and if this is going to continue on, those are likely names that are going to have to play catch up, and that's where you're probably going to get higher rates of return in the overall market today. My point is, knowing whether we're in a bull market or we're in the eve of a bear market is extremely difficult, not something that I want to predict. Therefore, for me, because I do expect small caps to perform poorly in down markets, which we've actually been seeing. On up markets, they perform very well. On down markets, they could get crushed pretty badly. That's a binary outcome, and it's just not something that I want to risk my capital on.
And I think that's something to keep in mind, because even when we're talking about small caps as a category, there's so many different types of companies, right?
Right.
So we have to understand that there's so many factors that go into play when we're talking about sectors. And with an index, even like the Russell, there might be this narrative out there that, oh, we're seeing the Russell higher, but not the case with the other equity averages. But it goes so much deeper, and we have to look at individual names as well as companies as well.
That's a great point. That's a great point.
Well, Dan, thank you so much for joining me. And of course, I look forward to speaking with you as we head into the rest of this year. So thank you for laying it out there for us and for helping the viewer understand what's happening.
You're so welcome. It's a pleasure to be here, and I look forward to returning.
Thank you so much, Dan. And for all of our viewers out there today, thank you so much for joining us. We're live at the New York Stock Exchange, and we're so excited to bring you this programming for Sampro TV. So for all of you watching, thank you so much for joining me. We're so excited to bring this daily coverage here on a regular basis. So we look forward to seeing you bright and early, at least from New York, tomorrow morning. Have a wonderful day.